Okay, good afternoon. Blue Chip Trader here, and on this fine day here of trading activity. And I just want to give a brief educational piece here discussing risk and money management. And I think it's pretty apropos considering that Q4 of last year, which just ended a few weeks ago, the markets went through a pretty aggressive distribution activity. And it seemed like a lot of people, a lot of traders that we were talking to, they were losing some money because they weren't assessing the overall risk that was going on in front of their eyes during the market correction. And this is really kind of a piece that I'm putting together to just kind of reinforce the basic risk and money management tips when it comes to short-term trading. And first and foremost, if you haven't done so already, you should have a separate account set up for your short-term trading. Something that's completely separate from a longer-term investing account or your IRA or 401k. You should have a separate short-term trading account. You never really want to commingle the money for longer-term investments, dividend-paying stocks, or something that, longer-term asset growing or value plays. You don't want to commingle that money with your shorter-term day trading or swing trading style or strategies that you have implemented to make some sort of, to grow some short-term capital. You want to keep those separate funds. You want to keep those funds separated. And the main reason you want to do that is because a lot of times what happens is if you don't have the discipline or you don't have a set strategy for your day and swing trading, when it comes time to take a loss, you're going to basically, if you don't swallow your pride and you don't have the discipline to do so, you're basically going to have a tendency to turn that losing trade into a longer-term investment. And that longer-term investment, the further and longer that it stays out of your favor and not profitable, you're going to wind up turning that into a longer-term thing. So now you're basically co-mingling strategies. So one of the key successes to short-term trading is having that short-term account separate from your other ones. You don't want to be, messing with the strategies that you have to deploy there to succeed. Second thing I want to kind of highlight here was, trading is not a game of perfection. You're never really going for perfection in the market. What you're trying to do is recognize the situations at hand in front of you and take advantage of what seem like low risk, high probability, high reward probabilities, and you want to capitalize on that. And I think a perfect example would be taking a Major League Baseball player, because on average, a good player is basically batting around 300, maybe even 400 in a good season, right? And what that means is that they're basically hitting the ball approximately 30% of the time out of 10 times at bat. That's 30% of the times. They are striking out the other 70% of the time. Now, if baseball players, if they mentally let that get in their mind, that they are striking out more often than they are actually hitting the ball, well, then they're going to go into that slump. They're going to wind up questioning their talents and skills that got them into the big league in the first place. And basically, I always think that baseball players actually make really good traders because they actually understand that losing or striking out is part of the game. It's part of the trading game. You have to be willing to accept those losses. And it's amazingly in baseball, I mean, anybody that's hitting 400 is basically considered to be a fantastic player, and they're striking out more than half the time. So keep that in the back of your mind as you become a trader. You're not aiming for perfection. You're not aiming to have consistent, or just constantly have the most percentage of winning trades. You're aiming to capitalize on those circumstances that you do have winners. And basically what that means is that 30% of the time or 40% of the time that baseball players are hitting the ball, they're hitting doubles, triples, and home runs. They're just capitalizing on them big time. Or maybe even they're just consistently hitting singles and getting on base. But the point is that you have to have that mentality going into trading, and you have to approach the market with that aspect of risk in the back of your mind. And that's going to bring me to the next part. And when it comes to risk and money management, the core foundation of how to get a handle on that is going to come down to position sizing. Now, everyone's risk tolerance is going to be completely different, and everyone's account sizes are going to be completely different. But in my experience, it's best to stick to one mantra, and it's you have to earn the right to trade large size. I'll repeat that. You have to earn the right to trade large size. And when I say earn, I mean that literally. You actually have to make money consistently and grow your account in order to increase the size that you are trading. Now, the way you do that is that everyone starts off small, and in my opinion, if you're a newbie trader or even an intermediate trader that's somewhat struggling, you should almost be trading a negligible amount, something that really wouldn't matter so much if it went against you. And you should consistently trade that amount until you can develop a discipline of locking in profits as well as locking in losses. And the key there is that by trading small enough, you're not letting your emotions get involved. You're not focused on the actual money itself. Instead, you're going to be focusing on the price action and your planned strategy, and you're going to be focusing on developing a discipline to actually get out when you're proven wrong, or to lock in some partial profits when things do work in your favor. So that is a crucial aspect of risk management. And only after you grow your account, and in fact, I would say it's best to set some benchmarks on your account. So say you have like a $50,000 trading account. Say to yourself, if you get up to $75,000, well, then you're going to gradually increase the size of your positions. Maybe by 10%, maybe by 100 shares. Who knows what it is? If you're trading options, maybe or futures, maybe it's an additional contract. But you have to basically set those benchmarks for yourself in order to increase your size and grow your account over time. Now, if you take a hit after you increase your size, well, then you're going to have to drop back your size. Don't try to revenge trade by keeping your size the same, all right? So that's a very critical point, too. Set those benchmarks for yourself. Also, you're going to eventually get to a point where, you increase your position sizes, and you're going to feel discomfort. You're going to feel that feeling of, hey, you know what? I'm not comfortable with these levels here and the price action that's going on, and I need to cut back my share size. And two little subtle signs of that, they have this what's called the sleep test. If you're holding a swing trade and you're thinking about that position when you go home at night, and it's the last thing on your mind when you go to sleep, and it's the first thing on your mind when you wake up in the morning, there's a good chance that that position size is way too big for you to handle. It's outside of your comfort zone, so to speak. The other telltale sign is, we laugh about this in the office every now and then, is look and see how close you are to your monitor. If you have a position size on and you are literally have your face within inches of the screen because you're zooming in on all the price action, and you try to focus on every little tick that's going on there, and you're just getting closer and closer to your screen, and you probably haven't even taken a bathroom break, to be honest with you, in probably a couple hours because you're focusing so much on that position. Again, you're probably trading bigger than you should, so you should definitely cut back on those sizes. The other great thing about just trading smaller size too is that you give yourself a lot more leeway or wiggle room to actually have price action work in your favor. So by trading a larger size, you're basically narrowing that gap that says you have to be right then and there. You have to be correct. And the stock price must move in your direction that you expected it to, on very quickly, very soon. By trading smaller size, typically you can just allow the market to go through the noise and the reactions that it typically does. Let the algorithms take hold. Let other traders make those crazy decisions and their emotions that run wild. But you, by trading smaller size, you're going to basically give yourself a lot more leeway. This is all going to lead to my next part of risk and money management, which is understanding the actual behavior of the vehicle that you are trading. And in addition to that, you also have to understand the broader market environment that you're currently in, or understand the market conditions that are going on around that particular sector or that particular stock or ETF, whatever vehicle it is that you're trading. So if we start off with some individual stocks or ETFs or whatever it is you're trading, most traders, they got to pay attention to the average daily volume and the average daily range. And for some stocks, you're probably even going to want to check out the size of the float or the shares outstanding, because all these three factors, the average daily volume, daily range, and the float of a stock, is going to all basically culminate into the volatility of the stock itself. Now, the more volatile or illiquid a stock is, the more likely it has a tendency to make these sharper moves against you, and you're going to want to trade smaller size with them. Or if you really like a name, sometimes, for example, like our emerging growth focus list, they tend to be on the smaller to mid-cap growth names, and they tend to trade on the lighter side of volume, about 100 to, say, 500,000 shares average daily volume. So something like that, you might want to consider even scaling into these positions over a period of days or time, and keeping each trade small. And by keeping it small and scaling in, you're going to be able to manage that risk and tolerate the moves that come with a little bit more illiquid or volatile stocks. So something to keep a little bit more in mind there as you approach. Pay attention to the average daily volume and the average daily range. Something more stable, like the big blue chip stocks like a Microsoft or Verizon, you can usually take on a little bit more size, knowing that you're probably not going to see anything drastic on a daily basis of more than a few percentage points here and there. So definitely focus in on the liquidity and the daily ranges on stocks. Now, for assessing the broader market conditions, there are more than enough tools and indicators out there to assess what's going on with the market. But basically, in a nutshell, you're trying to figure out is the market in a risk-on or risk-off mode. And one of the more common or favorite ones, especially here amongst the trading team here, the trading community, is one of the common tools is the VIX, or the Volatility Index. This has bunch of nicknames. I think the Fear Index is one of the names that it's called. And generally speaking, a rising VIX means that there's increasing volatility in the market, which means that price action on a general basis is getting faster and looser. And more often than not, that type of behavior is typically associated with a bearish environment in prices. And that's because prices have a tendency to drop a lot faster than they rise. It's that old analogy of putting up a skyscraper. It takes months and months of planning and workers to just build, and then you can have a demolition team come in there and destroy the whole thing in one day. So it's just, volatility is the same way. When volatility is low, or the VIX is low, usually in the mid to lower teen area, or even sometimes it's gotten lower, but the longer that it stays, say, let's go take, say, below the 20 mark, they usually suggest that there's a low volatility in the market or complacency with where the market is trading. And when the VIX is spiking higher and it's jumping above the 20 mark, those tend to be a little bit more unfavorable conditions for traders. So you might want to take a little bit more defensive actions if that's the case. So some more defensive actions you're going to want to consider is basically trading less, using some wider stop losses on smaller size, maybe hedging your portfolio with shorts or some put options, or even just preserving capital by moving to cash. Those are a few of the things that we were highly recommending through Q4 that really, we believe, helped a lot of us personally save a lot of money, and as well as our subscribers. And then finally, let's talk about just locking in profits. there's an old saying that says, let your profits run. Obviously, it's a lot easier said than done. You don't want to get too greedy, but you also don't want to, get out too early. But one of the simplest solutions that I've taken to heart over the years and just seeing it just work out very well in my favor as a swing trader is just taking partial profits. Once price action moves in your favor, typically if it's a one-to-one relationship to your risk that you initially had on the trade, or 2-to-1, you scale out some profits. You trim something, you take a little bit off the table, and then you tighten up your stops closer towards your break-even area. At that point on, you shouldn't really care where the stock price goes because you're playing with the house money. And that can go on for weeks or days on end, and eventually you can scale out some more, and then you're going to maybe just get out of the whole entire position at a point that you're happy with. But taking something off initially when price starts moving in your favor, it alleviates a lot of the tension that's associated with the risk that you initially took on. I'm a big fan of rewarding yourself for taking on that risk initially. So the bottom line here is that if you were to talk to any experienced trader that earns consistent profits year in and year out, they're going to tell you that it all comes down to managing your own risk on a trade. You never want to get yourself into a situation where the losses are going to make you struggle and you're going to have to dig yourself out of a hole just to get back to break even. It's a really difficult thing to do, and it's basically the number one reason why a lot of traders fail at this business. If you're going to keep your risk under control, then the profits are just going to have a tendency to appear a lot easier with a lot less stress. So that's basically today's educational tip here. Hopefully you get a little something out of it. And if you have any feedback for us or you have any further commentary, just go ahead and use that Talk to Us link at the top of the page. And we'll try to get this going maybe once a week, give a little professional tip out there for everyone to kind of stay on the course and stay on earn those consistent profits. Gavin will be up here in a couple minutes to discuss the earnings coming up for tonight as well as tomorrow morning and any sort of economic data that we should be aware of. Thanks.